1. Start with energy, explain with authority, highlight with emphasis, end with warmth. Right now, Supermicro Computer, ticker SMCI, is trading live at $40.17. That's up about 41 cents, or just over 1% in live intraday trading on this November 10th, 2025. And right away, that $40 price tag tells a story of intense conflict. The expectation, the market narrative that has been sold to so many investors is that SMCI is a core beneficiary of the entire AI build-out, a key partner for Nvidia stock, and a pure play on data center expansion. The reality, however, is that the stock is currently trading more than 38% below its 52-week high, and its most recent earnings report, which landed just last week, was a brutal wake-up call for anyone who wasn't paying attention to the details. This isn't a simple growth story. This is a story about a company that is capturing massive, almost unbelievable revenue growth while simultaneously seeing its profitability absolutely collapse. It's a paradox, and it's catching a lot of people who are doing self-investing completely off guard. Look, the story for Supermicro is simple on the surface, or at least it was. The general belief, the one you'll hear from momentum chasers, is that you buy SMCI because it's a pick and shovel play on the AI boom. You aren't betting on one AI model or one software company, you're betting on the non-negotiable need for the hardware. Supermicro designs and assembles high-performance application-optimized servers and rack solutions. They are a go-to partner for companies that need custom-built systems, especially those using the latest GPUs from Nvidia. As companies like Google, Meta, and Microsoft, and 1,000 smaller ones race to build bigger, more powerful data centers, SMCI should be printing cash. That is the expectation. It's what draws investors on the Robinhood app and SoFi Invest to the name, seeing it as the next big thing. But the reality is far more complicated and, frankly, far more concerning. The problem isn't revenue. The company just raised its full-year revenue forecast to at least $36 billion. That's a staggering number. The problem is that this growth appears to be coming at a devastating cost to profitability. Their fiscal first quarter earnings, which came out on November 4th, were a disaster in the details. Revenue for the quarter was $5.02 billion. That sounds great, but the analyst consensus was for $5.8 billion. That is a massive miss. Not a small one, a giant one. Adjusted earnings per share came in at 35 cents, plunging 52% from the same quarter last year and missing the 37-cent consensus. But the real horror show was the gross margin. It plunged to 9.3%. Let me repeat that, 9.3%. That is down from 9.5% in the prior quarter and down from 13.1% just 1 year ago. This is the entire story. This is the expectation versus reality disconnect in a nutshell. Investors expected a high-growth, high-margin technology company, something that looks like Apple stock in its prime. Instead, they are getting a low-margin, commodity hardware assembler. A 9.3% gross margin is what you see from a distributor, not a key technology innovator. What this tells us is that to win these massive new AI contracts, Supermicro is in a brutal price war. They are being forced to slash their prices to compete with the giants, Dell, Hewlett-Packard Enterprise. They have no pricing power. They are winning the business, yes, but they are winning it by giving it away. This is why the stock is falling even as headlines tout its partnerships. And this creates the most confusing guidance I have seen in a long time. After missing Q1 so badly, management turned around and gave monster guidance for the second quarter. Revenue between $10 and $11 billion. The consensus was only $7.8 billion. They also raised the full-year outlook to that $36 billion number. So revenue is exploding, but the stock is falling. Why? Because their earnings per share guidance for Q2 was just 46 cents to 54 cents. Analysts were expecting 61 cents. The market has finally done the math. Massive, record-breaking revenue is translating into less profit than expected. This is the definition of a low-moat business. This isn't like Tesla stock, which for years enjoyed massive margins on its cars. This is a cutthroat, low-percentage business. The daily trading reflects this confusion. The stock has been incredibly volatile, with a 52-week range of $17.25 to $66.44. Today's volume is already over 10 million shares, which is high but nothing compared to the 30 million-plus average volume. This tells you institutional investors are actively managing their positions. We saw massive selling after those earnings last week, and the analyst community is completely torn, which is fueling the volatility for anyone doing online investing. On one hand, you have Rosenblatt, which just last week lowered its price target to $55 but kept a buy rating. They believe the margin pressure is temporary, a cost of scaling, and that the $13 billion in orders for new Blackwell Ultra systems will eventually pay off. On the other hand, you have Goldman Sachs, which has a strong sell rating and a $34 price target, and JP Morgan, which is holding a neutral stance with a $40 target. You have a strong sell from one of the biggest banks and a buy from a respected tech firm. This is what happens when the narrative breaks. When you are a self-investing individual, who do you trust? Do you trust the revenue growth or the margin collapse? This is why many people opt for something like Schwab Intelligent Portfolios, to avoid having to make these kinds of high-stakes calls on a single volatile name. But for those who are actively trading, whether on a platform like Interactive Brokers or just a simple individual brokerage account, SMCI is a battleground. Let's be clear about what supermicrocomputer actually does, because I think many people get this wrong. They don't make the chips. That's Nvidia stock. They don't build the software. They are an assembler. They take components, processors from Intel and AMD, GPUs from Nvidia, memory, storage, and they put them together in highly optimized server configurations for specific workloads like AI, cloud, or big data. This speed and customization has been their advantage. But that advantage is now being tested. As the AI server market becomes standardized, the big players like Dell and HPE are moving in. They have the scale, the supply chains, and the long-standing enterprise relationships to compete aggressively on price. And that 9.3% margin suggests they are succeeding in pressuring Supermicro. This is a classic growth trap. A company grows so fast that it outstrips its ability to control costs or maintain pricing. They are so focused on grabbing market share that they sacrifice the very profitability that would have made them a good long-term investment. The company says these are strategic investments to ramp up new massive-scale facilities and winning landmark deals. The market hears, "We are in a price war we can't win." This is a company with a market cap of over $23 billion, but its recent quarterly net income was only $168 million. That is incredibly thin for the amount of revenue they're processing. So what's the future outlook? This is where the expectation versus reality framework becomes your most important tool. The bull case, the expectation, is that the $36 billion revenue forecast is real. The margin pressure is temporary, just a cost of building out new massive-scale facilities and winning landmark deals. They have a $13 billion order book for Nvidia's next-gen Blackwell platform. If they can get through this ramp and start shipping those high-end systems, maybe, just maybe, the margins recover. In this scenario, the stock is incredibly cheap. A forward PE of 13.5 and a PEG ratio below 0.4 sounds like a deep value play. But the bear case, the reality, is much darker. The bear case is that the 9.3% margin isn't temporary, it's the new normal. It's the price of admission for competing against Dell and HPE. The bear case is that Supermicro is a low-moat business that is completely dependent on the product cycles of its suppliers, particularly Nvidia, and has a terrible recent track record of accurately forecasting its own business. Goldman's $34 price target suddenly looks very reasonable in this light. If margins don't recover, the E in that PE ratio is going